This trend will likely soon rock the U.S. financial system. Nearly everyone who buys groceries, fills their car tank with gas, pays rent, buys car insurance, and so on, is talking about the high cost of living. And it's true that consumer price inflation is higher today than before the pandemic, although it's nowhere near as high as it was 2 years ago, when the annual inflation rate spiked to a 40-year peak of 9.1%. Since then, the pace of inflation has slowed way down. In fact, the latest reading of the Consumer Price Index, or CPI, came in at 3%, close to the Federal Reserve's ideal target of 2% a year. But that's price inflation. There is another measure of inflation that has to do with money supply. It's the so-called monetary inflation, or the supply of printed money. It has also declined over the past 2 years and is likely to set to decrease even more. And while it sounds like a good trend, it's actually the opposite. Here's insight from our just-published July Elliott Wave theorist. Monetary inflation is unlikely to continue. Why? Because since early 2022, the Fed's clear aim has been to reduce the size of its balance sheet. Over the past 2 years, the value of the Fed's assets, representing printed money, has gone from $8.94 trillion to $7.22 trillion, a decline of nearly 20%. The July Elliott Wave theorist continues. This shrinkage of base money, moreover, has taken place even as total debt has expanded. This situation cannot maintain. The dichotomy will soon rock the financial system. It's just a matter of when. Indeed, U.S. household debt, which is part of that total debt the theorist is referring to, grew by $800 million from 2022 to 2023, including a 16.6% growth in credit card debt, according to MarketWatch. The financial website had this headline on June 20th. Americans are carrying record household debt into 2024. Interestingly, Washington, D.C. has the highest per capita credit card debt in the country. And speaking of the nation's capital, out-of-control spending has led to a national debt of nearly $35 trillion. As CBS News noted earlier this year, U.S. interest payments on its debt are set to exceed defense spending. The Congressional Budget Office projects the annual interest on the debt will hit $1.4 trillion by 2033. And this does not even consider the huge amount of debt at the state and local levels, as well as the debt of corporations. Our financial forecast service warned of a financial flameout at the start of 2007, before the worst financial crisis since the Great Depression. And it's time to learn what we're telling subscribers now. Just follow the link below to stay ahead of what will be tomorrow's news.